Today we get insight from someone with experience paying back a mountain of student loan debt. Jade Warshar, she is Ramsey Solutions personal finance expert and co-host of The Ramsey Show. Jade, you and your husband had over $400,000 of debt, $280,000 of which was in student loans. What mindset shift helped you tackle that balance head on, and how long did it take?
You know, first off, thanks for having me. The first thought is, hey, nobody's coming to save us. You know, my husband and I realized that pretty early on. No one's coming to forgive these loans. No one's going to swoop in and pay the balance for us. So it's something that you really have to take control of and look at those things that you can do day by day, step by step to really make an impact on your own personal student loans.
Well, let's talk about that step-by-step approach. What were the strategies that you implemented to make sure that you had the most impact?
Yeah, so finding a good financial plan is so important. And so for my husband and I, we decided on the Ramsey plan, which comprises of those 7 baby steps that a lot of us have heard of. The first step was, hey, you're about to tackle a lot of debt, so let's get a little bit of cushion, a little bit of savings to the side. So saving $1,000 first, that was an important thing. And then the next step is you do start to tackle the debt now that you've got that little cushion of savings. And the way you tackle that debt is using the debt snowball method, which is listing the debts by balance from smallest to largest. And what you do is you pay minimum payments on everything, and then whatever's left, you throw at that smallest debt. And you can find, you know, that inspiration and that motivation every time you pay off one debt. It's like, woohoo, we did it. And not only that, but now you get to take all that money that's freed up and throw it on the next smallest debt.
So for someone overwhelmed by student loans right now, what's the very first action that they should take?
The first action that I tell people is to just stop borrowing money, right? A lot of times we think we have to do a million things at once, but the first step really is a mental step. It takes place in your own mind, in your own emotions to say, you know what? Borrowing money is the problem, and I can't solve a problem while simultaneously creating it. So I need to stop the problem at the root. The root cause is I'm a person who borrows money, whether it's for student loans or cars or credit cards. That's how I get the things that I want in life, and that's what's gotten me into trouble. So I need to stop that practice today. And so, like I said, it's a mental exercise, but it really is the first step, is drawing that line in the sand. And then from there, we can start to tackle, you know, the debt by getting on a budget and start to work that debt snowball.
And now that student loan payments have resumed after that long COVID pause, what's your advice for borrowers trying to get back on track, especially if they've gotten used to not budgeting that in their monthly expenses?
Yeah, the first thing is to realize, hey, what happened in the past years since COVID in the last 5 years, that really was a point in time that we'll never see again, right? The government kind of extended their hand for far too long, and a lot of us did get comfortable, and we started to almost feel like we're entitled to have this extra money, and we shouldn't have to pay back the money that we borrowed and signed on the dotted line for, right? And so the first part of that is kind of taking ownership and say, hey, I kind of got a get out of jail free card for a while. That time is over. I got to take my head out of the sand, and I've got to really accept the fact that these are my loans and I have to pay them, right? So I think that's the part that a lot of Americans are struggling with is, hey, give me back the money you were giving me. Give me back the pause you were giving me. It's kind of like a moment that we can't accept, but we really do need to accept that.
And for someone that's about to head off to school, what's your best advice to help them avoid the kind of debt that you had and set them up for financial success after graduation?
Yeah, what you said is really important. You can't wait until you're about to head off to school to start making a plan for heading off to school. That really needs to start a lot earlier on in the teen years, and it's up to parents to really start those conversations early and have them often. What are the expectations around college? And I can tell you right now, the most important choice when it comes to college is the college or school that you choose. That's really indicative of whether or not you're going to be able to pay cash for college or not. And so I tell folks all the time, parents especially, tell your kids, you're going to an in-state school because we're not paying out-of-school tuition. You're going to bump up the cost astronomically. We can't afford that. Second, let's talk about community college for an opportunity there to get your gen eds out of the way at a very low cost. And then once those gen eds are out of the way, now we can go to a state school. Let's talk about what it looks like to do work studies, to apply for scholarships, to get grants. All of these things, they're free money, and they're money that's right at our fingertips if we're willing to do a little bit of work to get it.
And now that your debt is paid off, what's your top advice for building lasting financial health and maintaining that financial freedom that ultimately we're all looking to achieve?
You know, my biggest piece of advice is the time is going to pass anyway. It's really you look at this mountain of debt and you think, oh my gosh, I could never climb that hill. I could never pay this off. But 7 years is going to pass, 5 years is going to pass, a decade is going to pass. And during that time, you really can make a lot of headway. It took my husband and I really it was 7 years total, but to really pay off that bulk of student loans, it was really about 4 years to really cut into that. And that time is going to pass regardless. So you can either be very productive or you can make a bunch of excuses and keep putting it off and putting it off. But I guarantee you, if you start today, you are going to look up 5 years from now, and that debt is going to be gone. Working the Ramsey plan, we see that the average person is able to pay off all of their consumer debt in 2 years or less. So I'm really giving you a bump to say in 5 years it's going to all be gone.
All right, Jade, great advice.
We're giving you everything that you need to know about paying back your student loans. There are so many options out there, but income-based repayment, standard fixed monthly installments, and even potential loan forgiveness are some of the main ones. So, how do you know which payment plan is best for you? Here to break it all down, we've got Jan Miller, the president of Miller Student Loan Counseling and Consulting. Great to have you here with us, Jan. So what are the first things that you should do before you even start looking at potential payment plans?
Immediately you want to start and create your account for both the loan servicer and for federal student aid, which is going to be your FAFSA, studentaid.gov. And that's because you may have to use both of them. So your loan servicer handles deferments, forbearance, payments. Federal student aid is going to handle applications for income-driven plans and forgiveness programs.
So let's lay out a few key scenarios here. Many borrowers may find themselves in. First one, perhaps, if you have federal loans and you work for a nonprofit or a government agency, what payment plan might be best for you?
Yeah, so right now, of course, a lot of change with payment plans due to the recent court injunction on the SAVE program, and of course the new Republican bill coming. However, the income-based repayment plan is likely going to be the best option for public service loan forgiveness. And whenever you hear the term income-driven repayment, that refers to all plans: SAVE, pay-as-you-earn, revised pay-as-you-earn, ICR, IBR. The one that you want is income-based repayments, because that one you will certainly qualify for if your income is low enough.
Now, what if you have federal loans and you owe way more than your annual income?
Right. So if you don't work for a nonprofit, you still want to pursue income-driven plans, because your total out-of-pocket costs, even if you're considering potential tax consequences of the forgiveness at the end, is still going to be less if you make lower payments based on your income until the loan is forgiven, which forgiveness is still a real thing under that program. Additionally, it's going to increase your cash flow in the real time, so your payment's going to be lower. So you get to have your cake and eat it too, a lower payment and lower total costs on the loan if your debt is that much more than what you make yearly.
Now, what about someone with federal loans, but their income makes payments pretty affordable?
Well, again, if your credit's good and you're in a good position financially, and you can afford your monthly payments, you can afford, a payment of around 1% of what your balance is, then you want to consider a refinance and paying the loan in a more traditional sense at that point, because you hopefully can get a better interest rate, especially as inflation cools.
So there is this scenario as well. If a borrower has just private loans, what are the options there?
Just private loans, first of all, it's going to depend on your lender, right? So if you have Sallie Mae, they're going to be more flexible. They have a greater amount of forbearance. They have rate reduction and term extension programs that you can apply for. And they'll usually have additional options for you. And of course, one of the tricks is if you can't get any help from customer service, let the account go a few days past due, and the collections representatives will have a greater amount of authority to give you options if you have to do that. They don't report to credit until you're 45 days, so you can avoid that. If you have other, other lenders such as Citibank or Citizens Bank, you have less options. It's more like a traditional loan that you're going to owe a bank. And if you can refinance it, that's fine. But we often say in the office here that if you qualify for refinance, you probably don't need it or have a student loan problem. If you have a problem, then you probably don't qualify for it, because it'll show up in your financials. But if you can refinance, do it. If not, you're going to be stuck with that payment unless in severe or last resort situations you can't afford your payment. at which point then you can try and negotiate settlements or try and work out temporary payment arrangements with the lender themselves, but your options are more limited.
Today is all about interest rates and refinancing. An interest rate is basically the fee a lender charges for borrowing money. It is usually expressed as a percentage of the total principal amount owed. When refinancing, a borrower will swap their original loan for a new one, usually at a lower interest rate. Joining us now to discuss is Andrew Pentis. He's Bankrate consumer lending analyst and a certified student loan counselor. So Andrew, if you're just starting this process, what's the easiest way for borrowers to first check their current student loan interest rate so that they know the baseline of where they're starting?
Yeah, it really depends on what your type of loan is. So if you have a federal student loan, the best way to check your current student loan interest rate is to log into your account at studentaid.gov. You can also talk to your federal student loan servicer, though that's easier said than done with long wait times and a diminished Department of Education. But in terms of your private student loans, yeah, check your statements if you receive a paper bill in the mail, or contact your lender directly or log into their online portal if you can, but it should be fairly easy to collect those rates.
So what would you consider a quote unquote good rate for a student loan right now? And what should borrowers aim for if they're shopping around or thinking about refinancing?
Yeah, good rate is lower than the rate you currently have and the lowest possible rate that you can qualify for. That's the short answer. But for context, federal student loan interest rates have been in the single digits for a long time. It was recently announced that rates for next school year will actually descend a bit. We're in a higher rate environment for those private student loan rates and refinancing rates, but still there are single digit rates out there. So if you do have good credit or a creditworthy cosigner and you can lower your interest rate through refinancing, it can be really wise.
When does it actually make sense to refinance, and when should borrowers avoid it, especially if they do have some of those federal loans?
The slam dunk situation for refinancing your student loans is if you already have a private student loan with a high interest rate. And that's because if you refinance it to a lower rate, you're not giving anything up. You might even switch to a better lender. But the more complicated situation is if you have federal student loans and you're considering refinancing those or lumping those into a refinance application with your private loans. And the reason it's complicated is that federal loans contain a lot of safety nets and protections like access to income-driven repayment plans that cap your dues at a percentage of your monthly income, as well as pathways to loan forgiveness. So refinancing those loans would strip those benefits away and turn the federal loans into a private loan permanently. So you really want to tread cautiously about refinancing those government exclusive loans.
You mentioned better lenders. So if someone does decide to refinance, what types of lenders should they be considering?
All types. There are credit unions, banks, online lenders, and marketplaces like Bankrate, as well as state guaranteed and state funded agencies that offer student loan refinancing. So just like with any other consumer financial product, it really helps to survey the landscape, check in with different types of lenders, and that way you hopefully get various offers that you can compare and get the best deal possible for your situation.
And given the current economic uncertainty, what are some guidelines that borrowers should keep in mind before refinancing or locking in that new rate?
Yeah, the thing to harp on here really is that if you have that federal student loan and you're considering refinancing it, as you mentioned, given these uncertain economic times, you really should be hesitant to refinance those federal student loans, at least until the dust settles. And the reason for that, again, is that if you keep your federal student loan and something happens, maybe you lose your employment or lose some of your income, you have access to some relief through that federal student loan. So whether it be a deferment or forbearance that pauses your monthly dues, or that income-driven repayment plan that caps your monthly payment, those are really important protections to have when you might not be sure, for example, that you're holding on to your job. So definitely that's the best advice for now.
And we've been talking a lot about the Federal Reserve, how they could potentially lower interest rates sooner than expected. If you're considering refinancing now, can you refinance multiple times, or should you wait and try and slow play it?
Absolutely. This is not a situation where you have to feel like you need to time the market, because if you can get a lower interest rate right now, say by refinancing a private student loan, it could save you lots of money in interest. And then yes, say that rates descend in 2026 or later and you want to refinance again, you can absolutely do that. assuming that your credit has maintained and you've built up a positive payment history on your existing refinance loan.
Andrew, some smart tips for those borrowers. Thank you so much. Appreciate it.
Thanks for having me.
While student loans offer a grace period for repayment, you will usually eventually have to pay them back. Yeah, all week we're giving you everything that you need to know about paying back this money, and today we're breaking down the difference between paying off federal and private student loans. For that, we have Scott Buchanan, who is the Student Loan Servicing Alliance Executive Director. Scott, good to have you here with us. So let's start by explaining the difference between federal and private loans.
Yeah, thanks, Brad, for having me. The difference is primarily who is the lender. Federal student loans are lent directly by the federal government using money from Treasury, and private education loans are generally made by banks or other financial institutions using sort of private credit. They're very similar, the private education loans, to other consumer credit like credit cards or mortgages or things like that, where there's a test of credit worthiness that the lender will make, as opposed to the federal student loan program, where generally it's a federal entitlement. And so if you're going to school, have filled out the FAFSA, then you're entitled to get those loans.
How should borrowers approach federal loans?
Listen, federal loans are incredibly flexible in terms of your repayment options. You need to know what kind of loan you have. Do you have a unsubsidized loan? Do you have a plus loan or things like that? Because they can have different benefits, but there's a lot of options, including forbearances, deferments, income-driven repayment plans that can all dramatically adjust your monthly payment amount. So something you need to always look at is the total balance of your loans, and thinking about, even when you're in school and thinking about potential repayment, remember you're going to have to borrow over the course of 2 or 4 years, and think about that in your repayment options.
What about private loans? When should borrowers consider applying for them?
Listen, you should always apply for these loans as early as possible. Once you get your federal financial aid award letter from your institution, talk to the financial aid office, make sure you've maximized any institutional aid that you can possibly get that would reduce the amount you have to borrow, figure out how much federal loan availability you have, and then determine what your gap is going to be, because the federal loans may not cover all your costs, and that's when you might turn to a private education loan. And doing so earlier is better because you can shop around on private education loans and find a lender who's got the best offering for you in terms of an APR and the best sort of program options that are available under that loan.
So what should the plan of attack be for repayment?
Yeah, well, listen, make a budget, like all financial things. You need to know in advance. Like, that's sort of the advantage of sort of going to school and having this period of time generally when you don't have to make repayment. You have plenty of time to put together sort of what your plan of action is going to be when you graduate and leave. So, number one, don't overborrow in the first place, is what I always say. But if you have already borrowed, then make sure that you sit down, figure out each monthly payment that you're going to have, the differences between your federal and your private loans, because they're going to all have different monthly payments, different interest rates, and then put together a budget, a plan of action about how you're going to do it. Remember, when you first graduate, your income is likely to be a lot lower than it will be in the future. That's when you need to talk to your federal loan servicer and say, hey, here's my financial situation on the federal student loans. How can I lower my monthly payment, or how can I meet this budget that I have today? And they're going to have a lot more options. Whereas on the private loan side of things, it's going to be relatively set about the monthly payment.
If your loan has gone into default, what are the steps that you should start to take to make sure that you get back into good standing?
Yeah, well, that's very different between federal and private loans as well. But on the federal student loan, once you've reached 270 days delinquent, your loan can go into default, and that's when you need to call the default resolution group at the Department of Education. They will reach out and let you know that you're in default, and your servicer will as well. But that's who you need to talk to. There are lots of options, including rehabilitating the loan, potentially consolidating the loan, because getting out of default is something that you definitely want to do. And that's why loan rehabilitation would probably be your best bet on federal student loans, because that removes that default from your credit history. On private education loans, it's different. That's why you need to be very mindful about keeping on top of those private education loans, because once they go into default and charge off, there's not a whole lot you could do other than sort of negotiate a settlement or potentially a repayment plan to try to resolve the total amount of that debt.
And so once you have finally gotten to the point where you've fully paid off your student loans, then at that point, how are you kind of able to take advantage of, are there tax advantages as well that you should be making sure that you're also reporting?
Sure, absolutely. There's a federal interest deduction on student loans that you can take advantage of potentially. Now that is tied to income, so the higher income you are, the less likely are you be able to take that benefit. But you should definitely, during all of your repayment, make sure that you're as you're doing it in TurboTax or working with your accountant, make sure that you calculate the amount of interest that you pay. You'll get a statement from your loan servicer, just like you get W-2s and other things from your employer, that will tell you how much interest may be eligible, and you should definitely take advantage of that.
Scott, thanks so much for taking the time and breaking this all down.